Hello and welcome back for another summer school class brought to you by the eToro Academy. I am Sam North and as always, it is a pleasure to be your host today. Today's class is a super interesting subject and it is all about investing psychology. In my previous role working on a trading floor, mentoring aspiring traders, many of them knew that psychology was important but couldn't really explain what it was. Some of the most famous sports stars, including Michael Jordan, Tom Brady, and Rory McIlroy, have all used psychologists throughout their careers. You often hear about people saying a certain sport is 90% mental and 10% physical. You just have to watch Rafael Nadal's meticulous pre-serve routine to see how high he values having a process to reset his mind. With investing, it is vital as well. We need to create a process, understand ourselves, know our goals, and we can then be on the right track to achieving our potential. Now, I'm not saying I'm the best psychologist the world has ever seen, but I know what works for myself, and having worked with over 600 traders, I have seen what works for other people too. It is important to note that one thing that will help massively with all aspects of investing is, of course, experience. For those investors who want to be more active, remember on eToro you do have access to the virtual account to try things out. Before we go through some useful tips which will help you create some rules for your process, let's discuss what can happen when you lose control of your investing mindset. Individuals with a poor investment mindset can blow up their accounts, lose everything they worked hard for, and make mistakes which can affect them for a long period of time. Now, I know that sounds dramatic, but I have seen it happen to people where they let their emotions get the best of them, and next thing they know, they have lost a considerable amount of money. Over the years, I have asked many successful investors about the best investments they have made, and guess what the majority of them say? They say the best investment they made was taking a losing trade off early. They don't mention the winners, they mention accepting they were wrong even when they wanted to be right, because it was the right thing to do. Let's now go over some useful tips. Firstly, focus on your strategy. Hopefully, the previous classes have helped you understand what kind of investor you will be. So if you are someone who is long-term focused and you have set rules to get into an investment for a long period of time, don't get drawn into investing in a position for 1 or 2 months because you heard someone talking about how a stock might go parabolic. Even if it does, remember your why. A great saying is, a loss of opportunity is better than a loss of capital. Get your process nailed down and rinse and repeat it. Secondly, ignore the crowd. Too many times I've seen people get influenced by what others are saying, whether that be friends, news, social media, and so on. If your reason for investing in something hasn't changed, then stay patient and let it play out. There are great places to get information and there are of course experts out there who can help, but just remember your investing journey is yours and not theirs. Just because they say something, it doesn't mean they have the same time horizon as you or that they would even invest in the same way as you either. Thirdly, spread your risk and be diversified. There is nothing worse than having all your money on just one thing. Some people will even struggle sleeping because of that risk. There is no guarantee that anything we invest in will go up in value. By spreading the risk, being more diversified and not having all your eggs in one basket, you will feel so much calmer and be able to think a lot more clearly. Fourthly, don't feel like you have to time the market perfectly. Dollar cost averaging can be a great approach for many investors. It can help you psychologically too by taking out the emotion of being tied to one price. Instead, every month, for example, you are buying regardless of where the price is trading. If price falls, you're effectively buying lower anyway too. Lastly, have patience. I know it is the most cringy cliche saying, but Rome wasn't built in a day, and nor will your future portfolio. Don't chase big overnight returns, that doesn't usually end too well. Remember your goals, create the process, and take your time. Other useful pieces of advice from a psychological standpoint is to understand that the market will do what the market wants to do. Another great saying is that the market can remain irrational longer than you can remain solvent. Also, don't chase your losses. We are going to lose investments. That is fine. Learn how to lose before you can win. Have a plan for that and have a process you follow each time before investing. Create a checklist. If the investment doesn't meet the criteria, move on. The best investors will have a process and they will stick to it religiously. They will avoid FOMO, following other investors' views, looking for a quick buck, and not letting missed opportunities get them down. One thing that I see time and again when speaking with successful investors is that at some point they have used a journal or still do. An investing or trading journal can show you so much useful information. It can show you where you are best trading, what you are best at, and equally importantly, what you are worst at. It can show you the technique that works best for you, when you perform best, whether you are too cautious or too optimistic, and so much more. By writing or typing up your investments, you can usually get the real stats on how you perform. With these stats, it can help you to create and nail down your process. From a personal perspective, I found out I was pretty awful at trading the news. So guess what? I don't do it now. Play to your strengths. Does Warren Buffett invest in altcoins on a 15-minute time horizon? No, he plays to his strengths. Make your investment boring and repetitive because the end result, hopefully making money, is not boring. By creating rules and having a plan, it helps massively from a psychological perspective to deal with the investment. In a way, you have already accepted every outcome. You understand beforehand where you are wrong, and you understand beforehand where you would be right. Those who don't have a plan will be on the edge the whole time and not know what to do. The truth is, when it comes to psychology, you can do all these questionnaires and read all these books to help your understanding on the subject, but no one knows yourself better than you. By creating rules and having a process and finding out what works best for you, you'll be well on the way to having a successful investing career. For our next few classes, we are going to go into more detail about investing during a recession, investing in the metaverse, and also discussing how inflation affects the markets. Until next time, I'm off to get a cocktail.